Hello and welcome to this Friday's morning market briefing. We've got lots to talk about. Firstly, the US economy defies recession fears with 3.3% growth in fourth quarter, as well as that EU digital rules will worsen iPhone user experience, claims Apple Store boss. We've got lots to talk about on the charts also, with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, make sure to subscribe. The first article to talk about is with this US economy. Now, in Q4 of last year, the US economy grew at 3.3% at an annualized rate. This proved fears wrong on the topic of a US economic recession, causing Biden to, of course, boast a victory. Now, this is very important for, two reasons. Well, lots of reasons, of course, but two main reasons. First one, of course, being how this will affect the Fed and its rate hiking cycle and its process of bringing down interest rates. It was interesting to see how we are seeing a higher level of growth than previously expected. This could, in fact, weigh on the Fed to even take more hawkish policy, as they do know they have greater leniency when carrying out certain rate rises or keeping rates where they are, just so they can make sure inflation is gone from the economy, as these kind of recession fears were weighing on policymakers and influencing them to possibly think about cutting rates earlier than expected. And that's definitely being seen in the ECB with the Eurozone. In the Eurozone with the ECB, where the Eurozone is ultimately struggling economically, and as a result of that, we are seeing an increase in political pressure against the ECB, where the ECB is just trying to keep rates high to make sure inflation comes down, whereas certain political leaders, such as Giorgia Meloni, is calling for the ECB to kind of cut rates because it's hurting so many economies. With Germany, the biggest economy of the Eurozone, struggling greatly during this period of high interest rates, high inflation, and as a result, we have seen contractions in the German economy, and especially in its key sectors, such as automobile manufacturing, where we have seen a great deal of issues. And this relates, of course, to the US economy because of those topics in relation to how this piece of data, where we are seeing a greater deal of growth than previously expected, how will that affect the Fed's policy decision making? And as I just said, ultimately, because we are seeing more of that growth than previously expected, we are more likely to see the Fed maintain a bit more of a hawkish policy. And, this is also interesting to know, coming off the back of some higher than expected previous inflation data, which also adds to a kind of increasingly hawkish picture during a period of very dovish sentiment from the Fed. So it'll be interesting to see how this piece of data, along with recent US inflation data, does affect the Fed's policy making. As initially, going back to November of last year and December of last year, we were initially expecting, or at least certain investors were expecting, rate cuts beginning in March. Now we're kind of pushing that back a month or two due to those inflation figures that we did receive recently, which did come in above expectations. But interestingly, with this growth figure from the US, it did come in higher than what economists had predicted. So we're seeing a greater strengthened economy during these times. And the last significant point I think to make in regards to the US economy and this kind of 3.3% growth figure is how this might now affect Joe Biden and what will likely be Donald Trump's presidential elections of 2024, where we will see them likely go head to head once again, but ultimately it'll be interesting to see how this figure affects it, because ultimately, as we'll get into, many voters within the US are not feeling happy in relation to Biden's kind of management of the economy. And this is kind of despite the fact that the US economy has remained a bright spot in the world in regards to maintaining economic growth and that sort of thing. And as well as that, in recent times we've kind of seen inflation drop down to levels lower than previously expected, but ultimately it does still seem like those initial inflation spikes, which saw inflation reach 10-year, multiple decade-year highs has weighed on voters' kind of perceptions and ultimately is influencing the way they feel about the economy. And that's what's going to be affecting, this election greatly. And that's why it's so important to kind of look at these economic figures and relate them to what may go on with future political kind of elections and that sort of thing. Now, the data further proved that the US economy has been a global economic bright spot, and that's what we just referenced, really, showing resilience despite the Fed's implementation of multi-year high interest rate levels. For 2023 as a whole, the US economy grew by 3.1%, making it the world's fastest growing advanced economy in 2023. Data also released yesterday showed consumer prices rose by 1.7% in Q4, down from the 2.6% figure 3 months earlier. All this data continues to add to the growing picture that the US economy will experience a soft landing where inflation falls to sustainable levels without a recession occurring. This positive economic data is expected to go on to help Biden ahead of that 2024 election. This comes in an effort to reverse widespread economic dissatisfaction over Biden and his administration's management of the economy, which is at an all-time high. It's 60% of voters disapproving of Biden's management of the economy in a recent poll. Donald Trump has utilized the recent bout of inflation as a core striking point against Biden. Following the data, US stock prices and bond prices moved slightly higher, with the S&P 500 being up 0.1% on the day. In other news, though, the ECB said it would hold rates steady after yesterday's rate decision. So, very important news to note on the US economy and even the ECB as well. But definitely keep your eyes on this. It'll be massively affecting, US assets and, of course, the way the Fed will, form its monetary policy in the coming months. So definitely keep your eyes on any US growth data or any data in relation to US's inflation as well. So keep your eyes on all of that. Next article to talk about, though, a very important one indeed, is EU digital rules, which will worsen iPhone users' experience, according to Apple Store boss. Now, a senior executive at Apple claimed new EU regulations will worsen iPhone experiences. This comes from Phil Schiller, who leads the Apple App Store with the bloc's new Digital Markets Act, forcing it to make changes which could worsen scam detection. Now, I think it wasn't too many months ago now, maybe a month or two ago, when we did talk about these EU digital rules and how that might affect Apple stock. I remember, the point where we did start hearing about these digital rules were going to be enforced on Apple. We did start to see sell-offs in Apple stock, which is why it's so important to kind of understand what kind of regulation is going to be affecting these big tech companies, as obviously it can weigh on their stock prices greatly and affect markets as a whole. But ultimately, this is very interesting because Apple has kind of maintained a monopoly specifically over its app store in an effort almost, to accumulate greater profits, of course, but also to kind of protect users from scams which could make Apple liable or cause its own issues. And ultimately, this has worked out well for Apple, with Apple having a strong, kind of scam detection system as a result, and those apps that do go through the Apple Store obviously having to pass through Apple's guidelines. So it'll be interesting to see how these EU digital rules do in fact weigh on Apple stock in other ways in relation to scam detection and that sort of thing, and how that might affect a user's experience will be very interesting indeed. Now, the digital Apple's has long resisted the changes, but is now making historic changes to the iOS, with the move enabling users to access rival app stores and download apps elsewhere. This will be a strike to Apple, as they now lose out on the fees from app devs, and that's a key thing to definitely know. Now, Sheila's argument, however, hinges on the worry that the move reduces security for consumers, of course, with the Apple App Store long forcing Apple app developers to meet certain guidelines. The EU, however, argues that their legislation will help tackle the market power of Apple. Apple, however, is not the only is not the only corporation to deal with the issue or the regulations, which with those including Google, Amazon, Meta, and Microsoft all being forced to comply and adhere to the new rules. Apple will now also have to introduce a new fee structure, with the App Store now only receiving 17% of digital good sales revenue in comparison to 30% before. The Joe Biden administration has been very interested in breaking up monopoly power, as we've spoken about before, with I believe it was the DOJ being very, very interested in kind of dealing with issues in relation to Google's monopolies and also Amazon as well, and so that's kind of caused some tension within the tech industries between the politicians and the government, of course, and these kind of tech corporations. But ultimately, this kind of new regulation being implemented in the EU, which will likely help spread over into the US, especially with Joe Biden's administration in power currently. It would be interesting to see how that does maybe turn the kind of weight of regulation within the US as well, which will be very interesting to see. Definitely keep your eyes on news in relation to Apple and these EU digital rules. Keep your eyes on all of that. But that's all to talk about in the articles. And next to talk about, of course, is the charts. We are getting quite a bit. There is quite a bit of things happening to note. Now, to begin with, of course, we are talking about US indices and the US 30 to be specific, where ultimately, following the US 30 breaking above its ultimate highs on Friday of last week, we have seen price kind of range around the whole of this week so far, with price kind of after making those highs kind of returning back down to that key resistance level, which is now acting as a support level where there's lots of kind of buy side liquidity, and we're seeing price kind of range around and not make any moves to the upside really or downside, finding no real key momentum which we might note as significant. And this is important, of course, because ultimately, whilst we are at all-time highs, seeing this kind of stagnation could cause some worries. But ultimately, I think that the way that the US 30 is moving, the fact it is sitting on that key bullish level and it's very close to that 38.20, does still reinforce some significant bullish signs that price is just slowing down, retracing, accumulating, and preparing for another move to the upside. So still keep your eyes on that minus 27.2% Fibonacci extension level, as that'll be a very interesting level to see if price can make its way to there. Obviously, we will need some very key economic data to maybe push price one way or the other, but it will be interesting to see how this kind of US economic data that we've just spoken about does play into the charts as we end off the week and going into next week as well. So keep your eyes on the US 30 and US indices as a whole really. Next to talk about is the dollar, where there's not much happening. We are kind of seeing a similar ranging motion here, but ultimately, whilst we are kind of seeing a bit of a range, when we kind of look from a more distant perspective, ultimately price has just come into contact with that 50% Fibonacci level and that liquidity zone, and from there we've seen a significant amount of bullish momentum. So there's a good chance as well that we're just seeing the movement to the upside from the dollar, where we could be set to move all the way up to that 104.2 level on the dollar, which lines up with that minus 27.2% Fibonacci extension zone, which lines up with that key liquidity level. So that's the key area to note for the dollar, which will be interesting to see whether we can make our way up there now as we kind of do end off the week and enter the next one. So definitely keep your eyes on the dollar. Next to talk about is Euro USD, which is in a very interesting position considering it's just made a double bottom. We have kind of just seen price kind of hit this liquidity and use this liquidity to kind of make a slow bullish move away from there. But the question is, will we really find the necessary liquidity to continue a move to the upside from this double bottom, or in fact are we still presenting more of that weak momentum, and are we more likely to see a move to the downside This is heavily dependent, of course, on the ECB's kind of interest rate decision, which took place yesterday. So definitely read up on that to kind of understand what happened there and how that's going to affect the euro as we do end off the week. But ultimately, rates have stayed at their current levels, as I said. But there's been some interesting talks in relation to, there's been some interesting rhetoric from President Lagarde in regards, to disinflation. So definitely keep your eyes on that. Next to talk about though is pound yen, which this entire kind of period since it has reached this all-time high, pound yen has kind of stalled out and halted at this key resistance level and ultimate highs of pound yen. So whilst we have seen a great deal of bullish momentum to get there, we're now struggling to keep pushing higher. But definitely keep your eyes on pound yen. Whilst there isn't too much to kind of add to the current picture, which is that price is stalling at this resistance level, it's still very important to understand that pound yen has lots of upside potential and could definitely break above this resistance zone and kind of retest and move very far to the upside. So definitely keep your eyes on pound yen. Next to talk about though is Bitcoin, which is an interesting level since it's just retraced and now tapped that 50% Fibonacci mark and also kind of tapped that top resistance level. It'll be interesting to see now whether we'll sell off from this level and possibly even make our way down to that $38,000 a Bitcoin mark that we did mention as a key zone for Bitcoin, with it being a key area of liquidity prior. So definitely keep your eyes on Bitcoin. Very interesting position following, of course, those ETF kind of approvals by the SEC. So definitely keep your eyes on Bitcoin. Interesting to know, of course. Next to talk about though is gold, which is of course always an important topic to talk about, an important asset to talk about. However, there's not too much to say at the moment. Since coming into contact with that 6180 and key liquidity zone, we've kind of ranged about, not found too much momentum, but ultimately we've been slowly moving to the downside. So still keep your eyes on gold, as we do have the potential to still run very far to the downside. But obviously news from the Middle East, news from wars in Ukraine and elsewhere will definitely be pushing gold one way or the other, as world tensions do play a big part into gold, as well of course any data in regards to the US economy and the Fed. So keep your eyes on all of that. Next to talk about though is oil, which is in a very interesting position as it has pushed overwhelmingly to the upside, breaking its kind of stagnation where we have seen price kind of range around since the start of 2024. Really, not too much to say on oil for all that time, but finally we have now seen oil break out of this range, break above this key resistance level which price was stuck at, and is now moving very much to the upside. If we were to draw out a big Fibonacci retracement tool just to see how price is doing, we have just come into contact with that 78.60, so definitely look out for some bearish momentum on oil after coming into contact with that. Ultimately though, fundamentals are seriously playing into oil at the moment, which is now causing oil to push to the upside. So keep your eyes on oil. So interesting to look at and obviously analyze. That's all to talk about on the charts though. Lastly to talk about, of course, is the economic calendar, where we do have quite a bit of data coming up today on the last day of the week. Now firstly, we will be getting British consumer confidence figures, as well as that we're getting the German and French consumer confidence figure, as well as the Spanish unemployment rate figure. That's all the data that's coming from the Eurozone and Europe as a whole, including Britain, of course. But next we'll be getting the US core inflation and nominal inflation figure, and that's of course the PCE price index figure. So not the normal inflation figure, but another inflation figure to definitely note, and will be very important and definitely be pushing US indexes and assets one way or the other. And next talk about, we will be getting US personal expending figures, so other inflationary figures, and finally US pending home sales figures. But that's all to talk about on the economic calendar as well. We've covered lots on the we've covered lots on the articles, lots on the charts, and lots on the economic calendar. That's all from us at Wildwood Capital, though. Have a great trading day and a great weekend. We'll see you next week. Have a great one. See you later. Bye.